All right, let's get right into it. If you're running a business, or if you're the one handling the accounting here in Portugal, you absolutely need to hear this explainer. We are urgently looking at some brand new guidelines from the Autoridade Tributária, the AT, that completely upend how you have to correct invoicing errors and reclaim your IVA. Let's jump right in and hopefully save you from a massive audit headache down the road. Picture this, because we see it literally all the time. You've just finalized a sale, everything is great, but then you realize, oops, you made a tiny typo on the client's NIF, or maybe you misspelled their street address. Be honest, would your immediate reaction be to just jump into your software and issue a quick credit note to fix that simple typo? Well, hold your horses. Subverting what we've literally all done for years under the new rules, doing that is now a direct compliance violation. Using a credit note as a quick fix for a typo? Yeah, it's no longer allowed. Period. To see exactly why this is happening, we're looking directly at Ofício Circulado number 25-120. This is the document that officially kills off the outdated guidelines businesses have relied on since 1993. I mean, think about it. Those rules are older than a lot of the accounting software we actually use today. The AT is strictly modernizing VAT compliance and bringing our auditing standards into the digital age. So here's our roadmap for today's explainer. 1. The new AAT invoice rules. 2. Stop misusing credit notes. 3. Fixing formal errors correctly. 4. The VAT regularization trap. 5. Valid digital proof examples. And 6. Protecting your business. We're going to logically break down exactly how to fix errors and secure your IVA deductions without triggering those dreaded AAT fines. Let's start with Section 1, the new AT invoice rules, modernizing VAT compliance. The AT has essentially updated the rulebook to match modern digital billing realities, specifically aligning with Decree Law 97/2026. Moving right along to Section 2, stop misusing credit notes, the end of the catch-all fix. Over the decades, we've developed a really dangerous habit of using credit notes for absolutely every mistake under the sun. The ANT now explicitly forbids this. To fix this, we need to categorize our mistakes into two very distinct buckets. On one side, we have formal errors. These are things like inputting a wrong NIF, a bad address, a typo in the description, or just generating an invoice by total mistake. For these, credit notes are strictly forbidden. On the flip side, we have material errors. This is when you apply the wrong tax rate, a client returns goods, or you grant a retroactive discount. For material errors, credit notes are still the correct, legally required tool. And this brings up a massive legal distinction from the AT that honestly trips up so many people. If an operation never materially existed, say you accidentally hit generate twice on your billing software, that is an inexistence de opération, a non-existent operation. You simply cancel the invoice. But if it's an annulation de opération, meaning the operation is annulled because the goods actually exchanged hands but were returned later, that falls under Article 78 of the VAT Code, and that scenario absolutely requires a credit note. Which brings us to Section 3, fixing formal errors correctly, the AT-approved method. Let's map out exactly what you must do when you inevitably misspell a client's name. You have to follow the exact three-step process the AT demands. Step 1. Cancel the original incorrect invoice directly in your certified billing system. Step 2. Issue a brand new corrected invoice. Step 3. Ensure this new invoice expressly references the date the goods or services were originally supplied to safeguard the tax timeline. What you really should take away from this is that this method has zero impact on your IVA declarations. Because the tax value itself hasn't changed, it was just a typo, there is absolutely no VAT regularization needed. Let's look at Section 4, the VAT regularization trap, Article 78, strict proof requirements. We're now shifting focus to the highest risk area discussed in the source document, the incredibly strict new rules for reclaiming your IVA on material errors and returns. I really want to highlight this explosive quote straight from the Ofício Circulado. Translated, it says procedures based on tacit contractual presumptions do not satisfy the legal requirements. Basically, this proves to all of us that the old tacit agreement trick is legally dead. You can't just send a credit note, wait 15 days, and assume the client accepted it just because they didn't reply. No way. So, Section 5, valid digital proof examples, creating an unbreakable audit trail. If tacit agreement is out the window, what's the new burden of proof? You now need concrete, individualized evidence that the client actually knows about the credit note to safely deduct that IVA. The AT actually gives us 4 approved trails to protect ourselves here. Number 1, you can use the traditional physical note, signed and stamped by the client. 2, an email confirmation works, but it must have an explicit reply from the client acknowledging receipt. 3, you can use a client portal log, provided it shows a precise timestamp and user ID proving they downloaded the document. Or 4, a bank transfer refund receipt that is directly and explicitly linked to the credit note. Let's look at how this plays out in a real-world audit. A client replies to your email saying, "We confirm receipt of the credit note." Boom, valid proof. Your billing platform generates an automatic system log when they view the document. Valid proof. But if you send it and get crickets for 15 days, invalid proof. Deducting your IVA based on that silence is literally setting yourself up for an audit nightmare and some very heavy fines. Now, there is one crucial exception you need to know, and it's a game changer for B2C businesses. For final consumers, think of an online shopper returning a pair of shoes. Proving you actually refunded their bank account or credit card and linking that exact transaction to the credit note is perfectly valid proof to recover your IVA. You don't need the customer to sign a digital receipt if you can definitively prove the money went back into their exact account. Finally, Section 6, Protecting Your Business, Transition Rules and Next Steps. How do our software systems and internal daily procedures need to adapt to survive these strict new guidelines? Well, the AT gives us a clear timeline here. These Oficio Circulado 2520 rules were issued in July 2026. Right now, in the present day, you need to be implementing these new billing habits immediately. But they do recognize that some older billing software just cannot immediately issue VAT-only credit notes to fix tax rate errors, so they've granted a transitional grace period ending at the close of 2026. Until then, you can exceptionally use a credit note to annul the whole operation and reissue a new one for tax rate errors. But make no mistake, you absolutely must update your software systems before the year ends. Which really leaves us with one final, critical question to ask ourselves. Are your daily invoicing habits risking your IVA deductions? It's time to challenge your internal procedures. Don't wait around for a knock on the door. Audit your daily habits, train your billing staff on the strict difference between formal and material errors, and lock down your digital proof right now before the Autoridade Tributária does it for you. Thanks for joining me for this explainer, and I'll catch you on the next one.